Hey, hi. I think today we need to really look at, as you know, the market has kind of like corrected again, a bit back to square one, 13,000 plus for the NASDAQ, 13,700 to be precise. After one of the Fed chairs came out and give a warning that they might reduce their balance sheet which is a monetary tightening policy, and also they might increase the interest rates hike quicker and even at a larger amount, not at 25 basis point, but 0.5%. So amidst all these noises, right? I think one of the things that we need to really look at for weeks ahead is definitely the single number one factor, which is inflation. I think that will create all those subsequent words like recession being triggered, or um, more Fed heights, rate heights, and those things that will create more and more volatility in the market. So inflation, I think, is the first and foremost thing that we need to look at. As you can see, the inflation rate has been climbing for months, and the next question is, of course, are we looking at whether it has peaked, and when do we think that it will actually start to inflect down? Are we really at maximum fear right now? If we are really at maximum fear right now, then I think it's a really good time to actually enter the market. Of course, watch until the end of the video to see my opinion. I'll just show you a couple of research articles that I wanted to show you. As you can see, recession on the way. There's so many nonsense indicator. You got the inversion yield right now created by the Wall Street. You got the men's underwear index, by former Federal Reserve Chairman. Sales of the men's underwear, because it's the last piece of clothing man looks to buy, is a good indicator when times are hard. Usually this time the recession is very different from the previous ones. Recession usually happens when there's unemployment happens and all that, where the rate hikes are just too sudden and people can't take it, and people start to see that everything becomes more expensive. And last time, I think the Fed was not too sensitive to markets, and unlike the current ones, where they could just rate hikes and jam everything up, and you will see corporate earnings also. Corporate companies, so they will transfer those costs uh, over to the consumer, which actually makes, instead of increasing interest rates to reduce to stable prices, right? Which is their main aim, reduce inflation, but they ended up creating more inflation. So I think the Fed nowadays are more smarter and more sensitive to the market in general. So just show you that one of the um, news by Jim Cramer, he's saying that the market has peaked.
Dropped
Inflation has
0.27%,
peaked.
and the NASDAQ tumbled 1.34%, all part of the pivot. I'm talking about the fact that inflation is already peaking, courtesy of the Fed's decision to raise short-term interest rates quickly while selling off its huge hoard of bonds in the future, most likely jacking up the long rates at the same time. Suddenly, demand is softening, while supply is getting more plentiful for a host of goods and for homes. Now, as is often the case, people want to fight the Fed. Right at this moment, they can't bring themselves to believe that the party might be over.
So basically, he's saying that, especially for consumer stocks, right, inventories are high, demand are slowing down. So these are actually signs to show that inflation has peaked. There's no more a lesser chasing by consumer. And another thing I'd like to show you is the savings rate. Okay, what's the inverted yield? I think this is another mumbo jumbo created by the Wall Street to fear everyone from selling and just to give us sleepless nights. Yeah. Another part I'd like to show you is the U.S. household debts and credit card balances trend lower, means that debts are reducing. People are not really using credit card to spend, and these are good signs as well. Like China, savings rates are high, means that people are spending less, which will tame inflation as well.
Inflation and rising interest rates. One reason for that optimism is the still solid financial health of many households, as seen in a few charts from Truist Keith Lerner. In the first chart, you can see U.S. credit card balances have continued to trend lower from the great financial crisis. And then in the second chart we have here, higher wages and a higher stock market have allowed households to stay in debt reduction mode. Julian, it's interesting to see these charts because they, of course, come at a time when inflation continues to nip away at so many household budgets. And it's not just normal inflation. You're seeing food go up significantly, clothing prices go up significantly, but interesting charts nonetheless.
Well, if a lot of people in the U.S. are employed, if they're making more money, although on an inflation-adjusted basis, they're not doing as well, but if they have jobs, then they're not having to work down that savings, right, in order to pay for stuff. We're seeing those household balance sheets hold up relatively well. I guess the question is, how long does that balance continue, right?
Yeah, so basically, what she's saying is, of course, she's still quite concerned, but of the inflation, and also there's a need for the wages to catch up to the um, wages growth to catch up with inflation, so that people don't really shrink on spending until to the point whereby you will see all the corporates' earnings were to reduce as well. So it's a very delicate balance. My point of view is basically things are pretty much at its maximum fear, especially from the topic of inflation. We have had so many months, and since last year, middle of last 2021 onwards until now, it's been 9 months. We've been talking about inflation fears. I think this will probably be the beginning of things where start to inflation down. So it's actually a good thing. It's a good thing. So yeah, I hope you guys won't get distracted by all these fear talks out there about continuous inflation and all that. Everything has pretty much priced in. So yeah, thank you very much.